Welcome back, everyone. Today we will learn about the concepts of leverage and margin in detail. There are many misconceptions among traders regarding these concepts, so let's resolve them. We can only open trading positions in lots, but everyone wants to earn higher profits by investing a small amount of money. Therefore, the concepts of leverage and margin come into play in the market and are commonly used by traders. Understanding these concepts is essential, as they can significantly affect our trading outcomes. Leverage is like a loan provided by the brokerage firm to traders, and it is always represented as a ratio. This ratio indicates the proportion of borrowed funds to your own investment. Leverage allows you to multiply your investment several times for trading purposes, enabling traders to control larger positions with a smaller amount of money. For example, to hold a position worth $100,000, you only need to invest $1,000 by using leverage of 100. Traders should use leverage carefully because it not only enhances potential profits, but also increases potential losses in adverse situations. Your gains or losses will depend on the position you hold, and the profit or loss will be adjusted in your account balance. Margin is like a security deposit that you need to set aside in your trading account to open and maintain a leveraged position. It is usually expressed as a percentage of the total position size. Using the earlier example with 100 leverage and a $100,000 position, if the required margin is 2%, you would need to have $2,000 in your account as security. This ensures the broker that you can cover potential losses. Margin alert. A margin alert is a notification from your broker that informs you about the percentage of your used margin. It generally occurs when your account can no longer cover the margin required to maintain open positions. When you receive a margin call, you will be required to either deposit additional funds into your account or close out some of your open positions to bring your account's equity back above the required margin level. UITFX is the only platform that provides 2 margin alerts at different levels. The first alert informs you at 50%, providing you with sufficient time to cover the margin requirement before the final alert. Free margin. Free margin is the amount of money available in your trading account to open new positions or withstand potential losses. It is calculated as the difference between your account's equity and the used margin. Equity is the sum of your account balance and floating profit or loss, while used margin is the amount of money currently tied up to maintain your open positions. Stop-out level. The stop-out level is the minimum margin level that must be maintained in your trading account to avoid automatic closure of your open positions by your broker. It is usually expressed as a percentage and is set by the broker. If your account's equity falls below the stop-out level due to trading losses, your broker will automatically close your losing positions to prevent your account balance from going negative. The maximum or minimum levels of the above concepts vary between brokers and can be different for different account types. Stay tuned with us by following our social media platforms to enhance your knowledge about Forex trading.